Hello and welcome to Virtual Investor Conferences. My name is Bob Power, and on behalf of OTC Markets, we're very pleased you've joined us for our next live presentation from Horizon Oil. Before I introduce our speakers, please note you can submit your questions for the presenters in the question box to the left of the slides. Additionally, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Gavin Douglas, Chief Operating Officer, and Kyle Keen, Chief Financial Officer of Horizon Oil, which trades on the OTCQB venture market under the symbol HZNFF and on the ASX under the symbol HZN. Welcome, Gavin and Kyle.
Thank you, Bob. Good afternoon, everyone. We're very happy to be here today to present the Horizon story at the OTCQB Small Cap Virtual Investor Conference. I'm Gavin Douglas, the Chief Operating Officer of Horizon Oil Limited, and I have with me Kyle Keen, the company's Chief Financial Officer. Today we'll be taking you through a high-level review of who Horizon are and the company's operations, as well as bringing you up to speed with our FY22 financial position, following a week where, on the back of solid oil production rates and sustained oil prices, we reported our highest quarterly revenue in over 8 years and a net cash position of over $40 million. Following our presentation, we'll take any questions that you may have. So on page 2, we've got our cautionary statement, which relates to today's presentation, which I'll let you read afterwards at your leisure. So on to who we are. Horizon's an Australian-based company listed on the OTCQB and Australian stock exchanges, and we're focused on low-cost conventional oil production of approximately 4,000 barrels of oil per day net from our fields located in China and New Zealand. We have a 26.95% non-operated interest in Block 2212 offshore China and a 26% non-operated holding in the Maari field offshore New Zealand. We're a low-cost oil producer, highly leveraged to the oil price and generating strong cash flows. We have a strong balance sheet with net cash at financial year end of over $40 million and a history of returns to shareholders. We punch well above our weight with a relatively small team that get heavily involved in technical decision making on both of our assets. We recently commissioned a significant new field development in China, which has boosted production, and we have further growth plans to follow. So this slide highlights our strategy, and really our strategy is very simple. We aim to maximize free cash flow from our current high-quality assets. We are focused on making further distributions to shareholders when it makes sense to do so, and we will consider investing in new business if exceptional, with a particular focus on organic growth initiatives in China and New Zealand. We have a market cap of approximately 220 million Australian dollars, which is about 150 million, with 1.6 billion shares on issue. This chart shows share price movement since July of 2021, Horizon's share price in orange, oil price in green, and the ASX Energy Index in grey, and they're rebased to that July 21 date. The chart shows the linkage of our share price with oil price. For the last 12 months, we have been highly leveraged to the oil price, and as you can see, we've exceeded the ASX 200 Energy Index. So we're in pretty good shape at the moment. Just before we leave this slide, a little word about oil price. With continuing high demand and supply issues, and despite potential inflationary pressures, the analyst consensus view for oil is still that short to mid-term prices are in the $90 a barrel range plus. Sentiment has shifted away from fossil fuels. However, it's clear that oil will be part of the energy mix for some time to come. So on to our financial and commercial highlights. In order to give you a good sense of the financial health of the company, let me hand over to Kyle, who will briefly describe our FY 2022 highlights.
Thank you, Gavin. I have the easy part, which is talking to numbers which largely talk for themselves. Having said that, there's a few points I'd like to highlight, which are the company's low-cost operations, robust production, leverage to the oil price, and significant cash flow generation, especially when considered in context of our market capitalization. During the 2022 financial year, the company produced over 1.3 million barrels of oil with sales volumes of 1.2 million barrels. The company also managed to maintain cash operating costs at less than $20 a barrel of oil produced. This, coupled with a $90 realized oil price, resulted in a 70% increase in revenue and a 102% increase in net operating cash flow during the financial period. Revenue was $108 million and net operating cash flow $83 million, or approximately 75% of the company's enterprise value. Whilst we haven't released our EBITDAX result for the financial year, even at the bottom end of our guidance, being $65 million, the company is currently trading at an EV/EBITDAX multiple of less than 2. This significant cash generation and results in strong balance sheets with net cash of over $42 million at 30 June allows us to consider further capital management initiatives following $35 million returned to shareholders in August 2021.
Thanks, Kyle. From an operations perspective, as previously mentioned, we recently commissioned a significant new field development in China, which has boosted our production substantially. The 12-8 East project final investment decision was made in October of last year when oil prices were low. And following successful platform installation and the drilling of 6 development wells this year, commenced production into the current high oil price environment. In addition, we drilled 2 infill wells in Block 22/12 in 2021, which added over 2,000 barrels of oil a day gross to our production rates. And we have plans for another 1 to 2 development wells before the end of this calendar year. Across both assets, we successfully completed 10 workovers, which either restored or enhanced production, and we have additional workover activity currently ongoing in Block 22/12, which will provide a further boost. Through all of the infill drilling and workover projects, we've been successful in holding production broadly flat, while all the time maintaining cash operating costs at less than $20 per barrel. In terms of our ESG credentials, sustainability for Horizon means the management of risks and opportunities in a way that best balances the long-term needs of all of our stakeholders. First of all, on HSE, clearly in the business we're in, this is our priority. It's vitally important for us to know that our midlife assets are in excellent condition, that the high standards of safety are adhered to, that no one gets hurt, and we lose nothing to the environment. Our safety and environmental record across the assets this year has been excellent, tracking well below industry benchmarks. On governance, we promote and are committed to a high standard of integrity and ethical and transparent behaviour. With respect to people, we strive to make a positive impact in the communities where we are active, and we keep our staff motivated and supported. With regards to climate change, our priority is to reduce direct emissions through operational efficiencies. And in the past year, we've been voluntarily buying accredited carbon units for a community-based project in China, equivalent to 70% of our Beibu emissions. We reached a significant milestone this year, declaring our ambition to be net zero by 2050. And over the next year, we'll be working on developing our climate transition roadmap. Now on to the assets. I'd like to give you a bit more information on those assets. First off, Block 22/12 in China. Since the start of production in 2013, the oil rate's been maintained at between 8,000 and 10,000 barrels a day. That's a gross number. By undertaking a number of incremental activities, including new field developments, infill and near field exploration. We've also worked on progressively increasing our water handling capacity in the field and the project in general, and by having an operator which actively works to optimize production. Recently, we've been able to materially increase production from the asset to over 15,000 barrels of oil per day gross by bringing on the new 12-8 East field. As I'll discuss later in the presentation, the JV has a material pipeline of infill and near field drilling opportunities which aim to maintain future oil rates at or above this historical 8,000 to 10,000 barrels a day rate window. This slide shows a map of our assets. They're shown in the green rectangles in China. Production currently comes from 25 wells. The green blobs, there's 8 of them within those green rectangles. This geographic spread of reservoirs and assets mitigates the risk of significant disruptions to our cash flow. While historical production has been dominated by the 6-12 and 12-8 West fields, the 12-8 East field, shown at the bottom right-hand side of the graphic, is the most recent addition to our production base, having come on stream in Q2 of this year. On to that asset, and looking at it in a bit more detail, the 3D diagram on the right illustrates the main development. So we've got 6 producing wells and all in that development. We've got a deviated producing well in the deeper reservoir, which we call the Weizhou reservoir. We've got 5 horizontal producing wells in that shallower reservoir, the Jiaowei reservoir. And we've got a water disposal well for when the water rates increase in the field. The development includes self-installing, processing and wellhead platform and an export pipeline tied back to the existing facilities. The project was on production in only 18 months after the final investment decision was made, which is even more impressive when you consider that fabrication and installation occurred during COVID. Combined production from 12-8 East, Jiaowei and Weizhou reservoirs is expected to average 4,000 barrels of oil per day gross, or about 1,000 barrels of oil per day net to us for the first year of production. We're keeping a close eye on the rates. The wells in the field came on a few months. And, if we end up with a successful field production rate here, it may lead on to further development. So we're keeping a very close eye on the initial rates as we produce over these next couple of months. So we're not resting on our laurels. On to the future of the asset. This map shows the locations of 2 wells which we plan to drill this year, or at least are in consideration. The first of the 2 wells, the M3 well, has been approved by the joint venture and is part of a program which we recently kicked off. And then secondly, the North well, which is subject to JV approval, which we anticipate will be approved and drilled later this year. These new wells have been high-graded from our portfolio of opportunities, some of which you can see highlighted in orange on the map. Our strategy around high grading is to focus on targets that can be readily drilled from one of the 3 platforms. And that way, in the event of success, the wells can be immediately turned into production wells, whether they be infill appraisal or exploration wells. Also, as part of the current program, we are undertaking a 5-well workover campaign. This project is designed to reinstate and enhance production from the existing 6-12 wells. So just before I leave China, I think it's useful to have a word on the history of the asset and our view of its future. I should also note that while all the data on this slide was originally presented at the end of the last calendar year, it's fairly representative of the current state of play. We will be updating this slide with new numbers in the next month or 2, so keep an eye on our presentations. The decline profile representative of our current value inherent in the stock. The blue sawtooth profile is the additional production potential and value to be unlocked from future activities. Pleasingly, we have already successfully executed the first big production uplift with the commissioning of the 12-8 East field earlier this year, as I mentioned before. And also, as I mentioned, we are now embarking on workovers and further infill drilling to continue to unlock this value. So now on to our other asset. Maari in New Zealand continues to be an important asset for Horizon, generating approximately 30% of Horizon's cash flow. Importantly, over the last few years, production decline rate has been arrested through continued water injection into the main field, as well as well optimization. Our operating costs are modest in the context of the current. Planned workovers to deferred or delayed during COVID, but we expect those wells to be online shortly. So similar to Block 2212, all data on this slide was originally presented at the end of the last calendar year, but it is fairly representative of the current state of play, and as I mentioned, we'll be updating this slide in the next month or 2, so keep a close eye on subsequent releases. With regards to the future, the joint venture focus is to continue to keep base production relatively flat evaluate infill drilling opportunities, and seek to maintain field life to at least the end of the license period in December 2027, with the potential to extend being actively investigated. In terms of 2022 operations activity, this chart sets out the timing. Please note that some budget processes are in progress, and we stress that the timings are indicative and remain subject to JV and regulatory approvals, as well as rig availability. In Block 22/12, we have drilled 8 of the 9 approved wells, with another well subject to JV approval. The 12-8 East drilling campaign successfully extended over a continuous 6-month period, with first oil arriving early in Q2 2022. We have 5 workovers to carry out, that program having just started this week. In Mari, we are reinstating wells through workovers and planning for the next activity cycle. So in summary, Horizon is a small, low-cost oil producer with material positions and high-quality assets. We're highly leveraged to the oil price and generating strong cash flows. We have a strong balance sheet with net cash at financial year-end of over $40 million. We are determined to deliver value to shareholders, having distributed approximately 50 million Australian dollars through various capital management initiatives during 2021. Further capital management initiatives are under constant review, and the company will consider these when prudent to do so, needing to balance shareholder returns with managing liquidity levels and future commitments. And in terms of new business, our priority is to invest in organic growth within our existing portfolio to deliver shareholder value. We recently commissioned a new field development in China, which has boosted production, and have further growth plans to follow in both of our assets. We keep an eye out for opportunistic and organic growth opportunities, which could further enhance shareholder value, but I must stress that they need to have strong investment metrics and the potential to enhance our ability to make further distributions to shareholders to be considered. So that concludes our presentation. Many thanks for listening. We are now happy to take your questions.
Okay, thank you very much, Gav. So the first question we have is, what happened to Mari revenue in Q2 of 2022?
I'll take this one, Vas. Thank you very much for the question. So look, Mari revenue is generated on liftings from our FPSO, which is essentially the tanker that stores our production. So in Q2, there were no liftings. What you will see is a substantial increase in the inventory balance towards the back end of that quarter, and that inventory was sold through in the subsequent quarter being Q3.
Thanks, Kyle. The next question we have was any FY22 production impacted by any COVID shutdowns?
I'll take this one. In China, no. They did a great job of maintaining production throughout the COVID period. In New Zealand, production wasn't impacted, but some of our operations were. We had some workovers that we'd planned during that period, and they were delayed due to inavailability of equipment and the difficulty of getting qualified personnel into New Zealand. However, we're through all that now, and those workovers are now underway, and with any luck as well, should be online shortly.
Thank you, Gav. The final question we have is, what is your projected production in FY23?
Yeah, I'll take that one. Look, we're still working our way through that, and we're obviously looking at those numbers prior to announcing our year end. But at this stage, I would say that we're expecting Mari to remain flat. That's the plan. And in China, look, we're obviously at a good rate at the moment with regards to 12-8 East coming on. We announced to the market last week that we were getting rates in excess of 15,000 barrels a day out of the whole project. That boosted in large part to 12-8 East coming online. The nature of 12 East is that it does drop off quite quickly, the production from that field quite quickly. But certainly the base production from the other two fields, 6-12 and 12-8 West, we would expect to maintain within that 8,000 to 10,000 band that I mentioned in the previous slides. So yeah, we're off to a bit of a flyer this first quarter and into the second quarter, and through some of those initiatives that I mentioned, we're trying our best to obviously maintain production throughout FY23.
Great. Thank you very much, Gavin and Kyle, for your time today. This concludes our presentation at the Virtual Investor Conference.